Welcome to This Explainer. I am incredibly excited to share this with you today because we are going to dive deep, really deep, into the mathematical mechanics and the psychological traps that dictate exactly when your money finally starts working for you. Look, here's the honest truth that the internet's flashy financial gurus just won't tell you. Wealth isn't built through overnight lotteries, and it definitely isn't built by staring at glowing stock charts until your eyes bleed. Real wealth is built quietly. It's built through a highly specific engine of compounding that, frankly, most people completely misunderstand. So today, we're going completely under the hood. We're going to look at the cold, hard arithmetic of exactly how ordinary money transforms into extraordinary freedom. We are going to break down the specific phase transitions where your money basically starts sprinting on its own. And more importantly, we're going to uncover the psychological illusions that cause millions of people to throw in the towel right before the magic happens. We're breaking everything down practically today, so grab a notebook, get comfortable, and let's get started. Okay, let's dive right into this by acknowledging a feeling I know so many of us have had. It's that frustrating phase where you invest diligently, you do everything right, but your account balance barely seems to move. You know the drill. You open a brokerage account, you set up an automatic transfer of, say, $50 or $100 a month, you do the right thing, you skip a few dinners out, you make the sacrifices, then a few years pass. You eagerly log into your account, you look at the number, and you just think, wait, is this it? The growth is so tiny, it feels almost insulting. The market gave you what, $50, $100 over a couple years? Seriously, you could have made that much money just helping a buddy move accounts on a Saturday afternoon. It's at this exact moment that you start wondering if the entire game is just rigged for people who already have millions of dollars. You literally feel like a failure. But here's the secret. You aren't failing because you lack discipline. You feel like a failure because your expectation of what compounding looks like in the beginning is totally misaligned with reality. And this brings us to a brilliant concept from behavioral economist Richard Thaler. It's called the feedback gap. Listen to me. Your strategy isn't broken. It's just functioning at a scale that is way too small for your human brain to feel yet. You see, as humans, we are biologically wired to continue behaviors that produce visible, immediate results. If we touch a hot stove, we feel pain, we pull our hand back. If we eat sugar, we get a dopamine hit, we want more. We abandon behaviors that don't give us that immediate feedback. When you are in what we call phase 1 of wealth building, your compound interest is technically working under the surface, but the dollar output is just so microscopic that it falls completely below your brain's perceptual threshold. Your brain looks at a $5 return on a $100 investment and basically screams, "This isn't working, stop wasting our time." But the accurate mathematical reading is that it is working exactly as it was designed to. You just haven't built a large enough pile of capital for those percentages to actually matter yet. The single most expensive mistake you can make right here is changing your strategy, or worse, quitting entirely, simply because your brain misdiagnosed slow, early-stage math as a broken system. So here is our roadmap for today's explainer. We'll start with escaping the zero balance, then move into systems that prevent sabotage, explore the phase transition engine, and finally calculate the true cost of freedom. Let's start with part 1, escaping the zero balance. Getting off the starting line is purely psychological. Before you can even begin to worry about complex things like asset allocation, tax loss harvesting, or sequence of returns risk, you have to prove to yourself that you are actually capable of holding on to a single dollar. Nearly half of young adults right now are living paycheck to paycheck. And you know what? It's not always because of the math. A lot of times it's because of an ingrained mental sequence that dictates their entire financial life. That sequence says, money comes in and money immediately goes out. This is exactly where the $10 habit comes into play. The goal here is to interrupt your default sequence of spending immediately so you can build the core identity of an investor. You have to prove to yourself that you can save without your entire world collapsing. Now, I know what you're thinking. $10, that sounds ridiculously small, right? But the amount is entirely irrelevant. What actually matters here is the sequence. Right now, your brain's default sequence goes like this. Income arrives, bills and spending happen, and the balance goes down to zero. By moving exactly $10 into a separate, newly named account the exact second you get paid, you insert a psychological speed bump. The new sequence becomes, income arrives, I save, and then I spend. You do this every single time money enters your life. You get a paycheck, save $10. You sell an old jacket online, save $10. This tiny, completely friction-free action sends a massive, powerful signal to your identity. It says, I am someone who saves. You literally stop being a passive conduit for your money where it just flows right through you, and you start becoming an active director of it. Moving on to part 2, systems that prevent sabotage. Because once that habit is formed, You have to protect your growing balance from yourself. Here is the harsh truth about human psychology. Willpower is a finite resource. It runs out. If you try to build wealth relying purely on self-control and discipline, I guarantee you will eventually have a bad Tuesday, you'll get stressed out at work, and you will buy something you do not need just to feel a quick dopamine hit. We absolutely need to upgrade from relying on discipline to relying on architecture. Setting up a system where you separate your money into a bills account and a spending account eliminates frictionless spending. It's exactly like moving a bowl of candy from your desk to across the room. If it's right in front of you, you'll eat it. If you have to get up and walk across the room, you probably won't. Humans are notoriously terrible at mental accounting. If you have $2,000 sitting in one massive checking account, your brain looks at that big number and says, "Awesome, I have $2,000 to spend. Let's go." It completely conveniently ignores the fact that $1,200 of that is already spoken for by rent, $200 is for utilities, and $150 is for insurance. By setting up a dedicated bills account where the exact amount of your fixed expenses is automatically deposited from each paycheck and a totally separate spending account for things like groceries, gas, and fun, you completely eliminate the mental math. You move the candy bowl. If your spending account only shows $120, your brain just accepts that as reality. You don't have to stress and budget every penny. You just check one single number, and the system physically prevents you from accidentally spending your rent money on takeout. All right, part 3, the phase transition engine. This right here is the absolute core mechanics of wealth creation. Listen closely, because almost every financial advisor out there treats wealth building as one long continuous process. It is not. There are 2 very distinct phases, and understanding the transition between them is going to completely change how you view your monthly deposits. Think of it like a car's turbocharger. Just like a turbocharger needs exhaust pressure to spin, your portfolio needs to cross the $100,000 threshold before the boost really kicks in and compounding starts generating more than your actual contributions. Think about that car. At low speeds, you are providing all the power by pushing the gas pedal. The turbo is physically sitting there in the engine, but there just isn't enough exhaust pressure to spin it yet. In investing, this is phase 1. Every single dollar you put in is just building pressure. The returns are tiny. The engine is running purely on your manual contributions. But look at the math on this slide. If you only put in $50 a month, you never build enough pressure. After 30 long years, you never even cross the $100,000 mark. You spend your entire life stuck in phase 1, doing all the heavy lifting yourself. But look what happens at $400 a month. You cross that critical $100,000 mark around year 14, and suddenly 8% of your pile is generating $8,000 a year, which is significantly more than the $4,800 you are manually contributing. The boost engages. From that specific month forward, your money is officially working harder than you are. And this number right here perfectly illustrates the massive gap in your terminal wealth after 30 years. It comes entirely down to this phase transition. Let's break this down because it's mind-blowing. The actual difference in out-of-pocket contributions between saving $50 a month and saving $400 a month over 30 years is $126,000. That's the manual cash you put in. But the difference in your final wealth, it is almost $600,000. That is the pure, raw power of the phase transition. When you hit that boost threshold, your money starts multiplying itself in ways that the human brain genuinely struggles to comprehend. So remember, the goal of phase 1 isn't to get rich. The sole obsessive goal of phase 1 is to get your pile of capital large enough, as fast as humanly possible, so that the percentages start producing dollar outputs you can actually feel in your real life. Now, before we map out a real-world example of exactly what this looks like in practice, I want to say this. If you are serious about reaching your own phase transition, make sure to hit subscribe to Langford Invests right now. On this channel, we strip away all the internet nonsense and bring you the pure math and the practical psychology required to actually build generational wealth. So if this explainer is shifting how you see your money, hit that subscribe button so you never miss a breakdown. All right, let's get into the practical numbers. Let's make this incredibly practical and look at a real-world application. Meet Marcus. He's a logistics manager, age 38. Now, Marcus has been putting away $150 a month for 8 years. He's looking at his account. He's frustrated because he only has $16,500. He completely thinks his investments are broken. But we know they aren't. He's just starving the engine of fuel. Now, here's where it gets interesting. Marcus has a car loan that is ending soon. The average American car payment is over $700. But let's just say Marcus frees up a modest $250 a month when that loan is paid off. Now, what do most people do? Most people will subconsciously absorb that newly freed up money right back into their lifestyle within about 90 days. It turns into slightly nicer dinners, a few extra streaming subscriptions, maybe a new phone upgrade. The money just vanishes. But Marcus doesn't do that.
Marcus sets up an automatic transfer the exact day that loan clears. He actively boosts his investment fuel to $400 a month. Because he made that one single decision to increase his fuel, he crosses the $100,000 boost threshold at age 51. The turbo kicks in. By the time he reaches 65, he retires with over $337,000. That is 3 times what he would have had, all because he strategically redirected cash flow before lifestyle inflation could sneak in and steal it.
Finally, we reach part 4, the true cost of freedom. This is the ultimate destination of wealth building.
If you walk outside right now and ask the average person on the street how much money they need to retire early, they'll throw out these astronomical numbers like $2 million, $5 million, or $10 million. They genuinely think wealth is an absolute mountain of cash designed to fund a life of supercars and private jets. But you have to understand, that is a consumer's definition of wealth. Society tells you that financial freedom requires millions of dollars to buy luxury items. But the investor brain? The investor brain knows that wealth is actually just having enough options to permanently escape the rat race. And here's the beautiful part. Options are surprisingly cheap to buy. True wealth is waking up on a random Tuesday and realizing your time belongs entirely to you. It's having the power to refuse a project that drains your energy, or the ability to walk away from a toxic boss, or the freedom to spend a month volunteering or learning a new skill without waking up at 3 a.m. panicking about rent. Wealth is not the ability to buy a mansion. It is the financial immortality that comes from fundamentally uncoupling your basic survival from a traditional 9-to-5 paycheck. Let's look at a hypothetical mathematical scenario to prove this. Consider a modest $500,000 portfolio averaging an 8.5% market return. Mathematically, that generates $42,500 a year, which breaks down to over $3,500 a month. Now, think about this. If you are debt-free, or if you've intentionally designed a low-overhead lifestyle, like maybe you have a paid-off mortgage or you decide to live in a slightly more affordable area, $3,500 a month covers all the basics. It covers rent, groceries, utilities, and your basic hobbies. Now, obviously, safe withdrawal rates in the real world do require a more conservative buffer to account for inflation and market downturns. We all know that. But the underlying concept remains the exact same. Once your investments yield more than your baseline survival cost, you hit financial immortality. The pile outlives you. You don't need to slowly drain your savings away like a leaking bathtub. And the best part? You can still work if you want to, but now the nature of that work transforms from a desperate survival requirement into a completely creative choice.
So, as you leave this explainer today, I want you to remember this one crucial thing. Every single dollar spent today carries a massive second price tag. It's the invisible price tag of the compounding wealth it could have become. So you have to ask yourself, what will you choose to fund tomorrow? The $500 you blow on a quick weekend trip or a flashy car upgrade today doesn't just cost you $500. It costs you the $10,000 that $500 would have compounded into over the next few decades. Now, I am not telling you to never enjoy your money. That's not the point. But I am asking you to be awake to the math. Recognize the feedback gap for what it is. Build the environmental systems that protect you from yourself. Relentlessly pursue crossing your phase transition threshold. Because at the end of the day, you aren't just buying stocks and assets, you are literally buying back the rest of your life. So take a hard look at your bank account today, find your friction points, and ask yourself, what is my next move going to be?